Okay, welcome everyone. I'm Don Rissmiller. I do economic research at Strategist, and I'm also GIC's chair for this year. So we're very happy to be able to return to the Chicago Fed. I'd like to say thank you especially to Bill Strauss for helping us get this great facility and again try to present a diversity of viewpoints on the economic outlook here today. One housekeeping item: if you'd like to ask a question, there's a little microphone in front of you. There's a button on that. If you push it, the light will blink, and that will mean you're active and ready to go. But using that should help us facilitate the Q&A process over the course of the day. A little bit about GIC. So if you look in your pamphlet, right inside the back cover is a description of the Global Interdependence Center. There are a number of upcoming events, both domestic and international. So we will have one in Victor, Idaho, also Frankfurt, Germany, and Madrid, Spain, and then a final in Philadelphia to round out the year, in addition to some of the other programs. If you're interested in any of those, please see me or Jill Fornito in the back, or check out interdependence.org for additional details. So with that, let me turn the panel over to Michael Drury, the Chief Economist at McVean and GIC's Chair Emeritus, to get the program started.
Thank you very much, Don. For those in Chicago of local interest, in both Madrid and Frankfurt, the guest speaker will be a fellow named Charles Evans. My job here is basically to be a clock watcher. We've got an hour and a half. I've asked each person to speak about 20 minutes. We're going to start with the front end of the economy, Dave Berson on housing. Then we're going to move to the back end of the economy with Laura Speake on heavy industry, capital spending, and ag, and then the unknown part of the economy with Jim Bianco on monetary policy and the street. I will become increasingly agitated as we get to 20 minutes, and we know they'll run over, but that would leave us a half hour for questions, and we expect a spirited reprise. We'll hold all questions until the end, and then field them all together. With no further ado, David Berson.
It's actually exciting when he gets agitated, so perhaps all the speakers should run over. That could be fun. All right.
Could I ask you to turn your phones off, please, so that, or silent. Thank you.
Macro, housing. As we all know, mortgage rates have fallen again. This is now about a week or two out of date. Rates are even a bit lower than this. So effectively, they're the lowest they've been since 2016. And when we look at housing demand is really determined by demographics. We'll look at it in a minute. Mortgage rates and income growth. And income growth is determined in large part by what's happening in the job market. And we'll look at that as well. So mortgage rates have dropped again. If you haven't refinanced, do it. Jim will tell us whether we'll have more opportunities to do it or not. To be honest, I'm surprised you have this opportunity, but that's why Jim's talking about monetary policy and I'm not. Affordability has moved up. Again, the latest number is a little higher than this. It is not at the peaks that we saw earlier in this expansion, but it's darn high. So affordability moving up clearly is a positive for housing demand. And again, if mortgage rates move down, ceteris paribus, we'll see affordability move up more, and that will increase housing demand further. Job growth is starting to slow. The 185 was actually our forecast for monthly growth before we got last month's number. I suspect it will be revised up, and we'll see 185 for this month. We'll know soon, but for the year, it probably won't be quite 185. Housing job growth is slowing. We'll have more discussion of that. Is it slowing because the economy is fundamentally turning down? Well, I doubt that we'll see 3% growth again this year, but I think it's slowing primarily because we're running out of workers. There aren't many left as we enter the 11th year of economic expansion. So job growth slower. That doesn't mean income growth will be slower. In fact, our expectation is that income growth will continue to slowly accelerate. Good for housing. We see from the JOLTS data, job openings remain very high. So it's not a slowdown in job openings. It's not businesses pulling back in their demand. Bill Dunkelberg's NFIB survey for small businesses continues to show that the biggest problem that small businesses face is finding qualified workers. So it is the lack of workers who can take jobs, not the lack of demand for workers, that is slowing job growth. That still suggests faster increase in wages. If in fact the slowing was a demand side thing, businesses didn't want to hire workers anymore, we would start to see wage growth roll over. I don't think that's what we're going to see. Income growth continues to be modest, but remarkably stable. If you looked at this over a much longer period of time, the last 3 years or so of relatively stable growth in incomes is very unusual. So basically income growth is a little above 4% per year. With inflation running a little under 2%, real income growth is not bad. Now, personal income growth may not rise much faster if we have job growth slowing, but wages picking up. So the overall increase in income growth, we think, will remain fairly close to this, but for those two different reasons. So wage growth trending higher is the Atlanta Fed's wage tracker. It's obviously quite volatile, but it is also clearly moving higher. I'm on the advisory board for the Cleveland Fed, and we meet quarterly with their economists. They come to major cities in their footprint, and listening to all the major businesses in Central Ohio. It's not just small businesses that are having problems. Big businesses are having problems finding workers, and we're all raising wages. I'm surprised this doesn't show faster wages. Columbus can't be the only place in the country where this is true. And what we're seeing increasingly is that firms are raiding other firms. We are losing employees to other firms, and we're taking their employees because we can't find them otherwise. And that's clear. How do you raid other firms to get employees? You raise wages. So we suspect this will continue to move higher. Again, positive for housing. Perhaps fundamentally, the most important thing for housing demand is demographics, and really it's household formations. And here we have the yearly change in household formations. The X is the most recent number. These are annual numbers. We put the X there as the change in the quarterly number. Household formations are moving up at a fairly rapid pace. Demographics, if you look at the age structure of the population, suggests that we ought to have somewhere, and we can make assumptions about immigration, we ought to be seeing somewhere between 1.1 and 1.2 million new households formed every year. We're clearly above that after a long period during and after the Great Recession, in which we were well below the demographic suggestion for where household formation should be. So we had pent up demand to form households. Millennials living in your basement. I had one living in mine. But you know, when they find a significant other, the significant other typically is not quite as hot in living in the parent's basement. A large portion of millennials are now age 30 and above. The ones coming out of college now are the Gen Zs. When I speak at Ohio State, I give a couple of guest lectures there every term. I tell them that they should thank their parents that they're coming out of college now and not 10 years ago, that the timing is perfect. Every household takes up space. It may rent, it may own, but it takes up space, and unless you get an increase in the supply of housing, you see the inventory of vacant units go down. If new households primarily go to the rental market, it pushes rents up and pushes those in the rental market who perhaps had thought about buying into the home ownership market. So whether they're renting or buying, they're pushing up the market for owner-occupied homes. How long can this continue? Well, we had quite a period of time in which household formations ran below trend. So I think we can see above trend household formations for at least the next several years, depending upon what happens in the economy, before we start to settle back towards the demographic trend of 1.1 to 1.2. We don't know what will happen with immigration. I'm not sure anybody does at this point. We could be on the upper end of that if there is agreement on immigration. We could be in the lower end, perhaps even a tad below that, if we get no agreement on immigration. But still, even with no immigration changes or smart immigration changes, we're only talking about probably 100 to maybe 200,000 per year at the most, difference between the bottom end and the top end. So 1.1 to 1.2. Supply constraints continue to hold the market back. So on the demand side, we've looked at mortgage rates, we've looked at job growth and income growth, we've looked at household growth. All of them tell us that housing demand should be going up. Yet, if you look at home sales are running below last year. In the second half of last year, they went down. In part, it was an affordability story. Let me quickly clip back to affordability. There we go. So we had a decent drop in affordability the second half of last year as mortgage rates went up. Again, since at least partially reversed. But supply constraints on both the new home market and the existing home market. In the existing home market, we're seeing many fewer homes for sale than we would normally see. So here we have the number of homes on the market from the National Association of Realtors. They don't seasonally adjust the data. I'm not sure why. It is an extremely seasonal series. So we seasonally adjusted for them. And so the seasonally adjusted data, so this is not quite NAR's number, it's our seasonal adjustment of the NAR numbers, shows that the number of homes, existing homes for sale, remains effectively at an all-time low. Despite housing demand picking up, despite the strong economy, people are putting their homes in the market. We thought for a while, and we'll get some idea if this is right or not, I think, in coming months, that we had so many households who currently own a home having either purchased or refinanced with mortgage rates at or below 4%. There's a significant share of the housing market with those very low mortgage rates. That there was a larger than usual share of existing homeowners who, if they put their home in the market and got something else, would have a higher mortgage rate, perhaps a significantly higher mortgage rate, and therefore decided they weren't going to do that. Well, now that mortgage rates are down again below 4 and perhaps moving well below 4, we may see that reverse. So we don't know that that is behaviorally what will occur, but it is one possible explanation for what's going on here. We also saw earlier in the expansion fairly weak job growth, but you know, it hasn't been weak for several years, and we still see the existing home number on the market near record lows. So I'm not quite sure what's going to boost this. Hopefully the lower mortgage rates will convince people who have already low mortgage rates that if they want to change, upsize, downsize, move to another job, that this is the time to do so, and we'll see supply pick up. If we look at the new home side, and here we have household formations relative to housing starts, and housing starts, of course, are both single and multifamily, but again, household formations, they can rent or they can buy, so it's total housing starts, not single, that you want to look at here. You know, they're moving up roughly together. Home builders tell us that they still have significant constraints in labor. They still are seeing some major components that go into homes more expensive, although that's no longer true for lumber, interestingly enough, despite the U.S. and Canada having a lumber tiff. After an immediate pickup in lumber prices, they've since fallen substantially. So it's not lumber prices doing this, but cement perhaps, other things that go into homes, but particularly the labor component of building homes. The builders tell us that it's slowing housing starts. But again, if you look at this, you don't want to build significantly faster than household formations are growing, nor do you want to build more slowly. It doesn't appear that on the new home side, we're seeing starts that are out of line from where they should be. Now, over the last year or two, we've certainly seen household formations pick up and they're running ahead of starts. So perhaps we will continue to see that. And if you ask me in a year, I may change my tune and say that, in fact, we're no longer building enough new dwelling units. But for now, we probably are building enough meaning consistent with the demographic increase that we're seeing. But it may be changing, so we may be on the cusp of a shortage on the new side as well. We've seen throughout much of this expansion, house price appreciation that has been, I would say, faster than sustainable. Sustainable being, over the long run, probably the rate of income growth. If house prices will grow forever faster than income growth, then eventually everybody pays all of their income to housing. So you can't have that. Well, we've had a number of periods in which house price growth is faster than income growth. Certainly true now, although house price appreciation has slowed in part as we had the slowdown in housing demand last year. But if we don't get a pickup in housing supply on the existing side, and I don't think the builders can grow much faster than they are, and we get a pickup in housing demand, lower mortgage rates, still good demographics, maybe even better, wage growth that's going up, there's a very good chance that the slowdown in house price appreciation, which is now slowed to around the pace of income growth, not below it, to about the pace of income growth, may reverse again, and we may be in a situation where we see house price appreciation going back maybe to 6%, again, an unsustainable pace, but because of supply and demand imbalances. So ultimately, as with every price, it's supply and demand, of course. I would like to see enough supply so that house price appreciation is 3.5% to 4% per year. You know, that's what the long run average should be. As with many things in economics, you're never at the long run. You're either above it or below it, but you never stay there. Perhaps except for GDP, if you look at the 4-quarter change in GDP over the last several years, it's just trended slowly higher at around a trend rate. But typically, we don't see things just stay at their equilibrium level. We're above or below. So this may move below for a little bit longer, simply because there's a significant trend component to house prices. But if we get another imbalance between supply and demand in the housing market, as I think we're headed for, the housing market looking stronger, but no significant increase on the supply side, we could easily see this pick up again to be somewhere above the current 4% pace or so. So the housing market looks pretty good, unless the economy falls out of bed, unless mortgage rates rise significantly. The demographics are the demographics. Nothing in the near term is going to change that. We expect housing activity to be reasonably good, certainly over the next year. Faster home sales than last year, maybe just a tad. And I would say only a tad because we were running below that for the first 5 months of the year, and certainly the first 4 months of the year. So we have to catch up, and I don't know that we can catch up given the supply constraints that we're seeing. But certainly over the second half of the year, housing activity that is stronger than the first half of the year and on par at a minimum with what we saw last year. And then home price gains probably picking up a little bit. If we look a little bit at the mortgage market, this is the MBA's Mortgage Credit Availability Index. Credit is more easily available now than it has been at any point in this expansion. It's particularly easy if we looked at some of the detail with FHA loans. So the pure government insured loans are now much easier to get. Fannie Freddie loans a little easier, but not much. And the private market, there's been a much more modest opening in the credit box than the overall market. So this looks like a pretty big increase in the credit box, a pretty hefty easing of credit standards. Depends where you look. If in fact we look all the way back to before the Great Recession, the solid line here is this. But you can look at the dots. So this used to be done not monthly, but quarterly, and that's why there were dots. And you can see that in the period before the Great Recession, in the housing boom, when I was at Fannie, we used to joke about the mirror test. You'll know what the mirror test is. Put the mirror under your nostrils. If it fogs up, you're alive. Well, you get a mortgage, maybe 2 or 3. And it wasn't really much harder than that. You can see the index was around 900. The index today is around 200. And it's an index, so the level itself doesn't matter. But the indexes are great for comparison purposes. It is, less than a quarter easier to get a mortgage now than it was back then, but it was just way too easy back then. We never want to go back to that. Unfortunately, the data don't go back farther than this. There are other measures of credit availability. CoreLogic has one that they don't often publish. They do it occasionally. And we've looked at that, and I've talked with the economists at MBA and CoreLogic, and we tried to sort of cobble things together. If you look back, I think housing economists like to think the mid to late 90s was sort of about right for the housing market in terms of supply and demand, including with the mortgage market. And mortgage availability and mortgage lending standards were somewhat similar in that period to where they are now. So I think lenders have it about right. Having said that, clearly lending standards are easing. It's not clear we need significant easing from here if, in fact, the long-run average of somewhere just around 200 or slightly below is what we saw in that mid to late 90s period where the market was pretty well balanced. So I would not like to see this go significantly higher, if indeed any higher at all. But right now, we're not seeing problems with mortgage delinquencies. These are the serious delinquencies. This is the back end. 90-day delinquencies plus those homes in foreclosure. We're at the sort of the historically average levels right now. We've run through the delinquencies that we saw during the Great Recession, during the housing bubble. This is likely to go down. It's a lagging indicator of things that would cause delinquencies now. My friend Ed Pinto at AEI would say that this greatly understates how easy credit is to get in the housing market. I'm not sure I agree with him, but if it went significantly higher than this, I would. So even at the front end, if you look at 30 and 60-day delinquency rates, things aren't moving up. So on the credit side, the market looks pretty good right now as well. I think that's all I have. No, I don't. It's home sales. So I mentioned earlier, home sales had fallen fallen off as mortgage rates moved up. And this is total, this is new plus existing. It doesn't include the most recent existing home sales numbers. We had to get the charts to Jill. Little did I know that other speakers in this panel changed their slides today. We could have given you updated numbers. But the trend in home sales appears to be up again. Rapidly, no, because of the supply constraints. And we probably don't want to see home sales, at least not for a while, until the demographics take us to where we need to go. Home sales equal to where we saw them when I was at Fannie Mae in the 2004 to 2006 period. Again, if you could fog the mirror, you got a mortgage and you got to buy a house, again, maybe several. And that's it. The disclosure, I always have to put the disclosure on. You all know what the disclosures say. Everything I said might be wrong. Don't bet the bank on it. So, thank you all very much. We're going to do questions at the end. Laura, you're up.
That's for 20 minutes and 30 seconds. He gets
I'll let you have 30 seconds of my time. So what I wanted to do is kind of give you a global macro view, step back a little bit, broaden the horizon a little bit, because as Caterpillar, we are very heavily dependent on the global economy and the macro situation around the world. And if you look at heavy machinery, it is very correlated with the global macro economy. And so look at our core businesses of construction, resource industries, mining, and energy. They are all very tied to how that situation is going. So just to set the stage a little bit for you, you know, obviously, well, and here's my statement and disclosures as well. I'll put mine up front instead of at the end. But obviously, you know, we're here in the U.S. We are a week away from the longest expansion in U.S. history. We have unemployment rate at a 49-year low, and GDP is reasonably strong and has been strong now for a while. The economy should be firing on all cylinders, but it feels very uncomfortable. As we look around the world, we see survey data is very weak. You look at financial markets and they are very skittish right now. And we see some of our countries that we are active in are actually weakening. So when we take this and we break it down, PMI is a good leading indicator for our business. You look around this, it's getting increasingly yellow and a little bit of red. So the numbers aren't really strictly important, but you can see the colors are starting to change. We're going from that very robust growth of the dark green into more yellows and reds. And so we're seeing that discomfort coming into the survey data, and it's really creating a situation where we have a lot of resources sitting on the sidelines because they're uncertain about what's coming. And so that really is, as we look, you saw Germany is the red up there at the top. So we do have some early indications that their economy has weakened substantially. It's not just the drought that they experienced last summer that disrupted trade along the Rhine. It is persisting for longer than that, even as the river has come back. You can see as we look at some of our indicators in China, the retail sales are down, the industrial production are down. If you look at electricity, industrial electricity use, it's also down. So we're seeing that weakness in China coming in. And we look at energy prices. This is kind of my wheelhouse as the energy and transportation economist. But we look at energy prices and they're not consistent with strong growth in the economy. The weakness that we've seen here over the last month or so has really been with respect to demand uncertainty. As we look at global growth in oil demand, earlier this year it was expected that we would see 1.2 to 1.4, even 1.5 million barrels a day of oil growth, demand growth this year. That's being revised down, and that we're now seeing 1 to 1.2, and even some discussion of less than 1 million barrels a day. And all of this is due to this uncertainty. The activity is still there so far. We look at the U.S., we're still seeing demand demand growth. We saw a little bit of seasonal issues around planting in the Midwest with the flooding that we've experienced. But other than that, we're seeing low prices that should give us a good demand growth for the summer. Globally, we're still seeing good demand growth, but prices have been incredibly weak, even with the controversy that we have in the Middle East right now. And we've probably seen, as we look at monetary policy, we've probably seen globally interest rates top out for the current cycle. We're starting to see easing, or at least discussions of capping out and the next moves being down as opposed to up in many countries. The big jump up there in the developing countries really revolves around Turkey, Argentina, and a couple of other countries that have had to increase their interest rates substantially to deal with inflation in those countries. So as we look at where we're headed, and kind of I wanted to take this back to set the baseline of where we are versus where we're going. You know, infrastructure is a huge underdeveloped resource. We have a substantial pent-up demand for infrastructure, not just here in the U.S., but around the world. Especially Europe is another big area where we're seeing pent-up demand for infrastructure, and we just can't seem to get ahead of it. We can't seem to move past this current status quo of not being able to get the work done to fund those infrastructure projects. If you look around the United States, we're seeing activity at the state and local level to bring forward infrastructure projects because the federal government is so far behind in actually getting a bill through to fund infrastructure. So as we look at where we're at and where that potential is going to come from, given the current status in Washington, I don't see a lot of activity and a lot of progress being made on infrastructure. And so we have to come up with some creative and new ways to fund that. As we look at where businesses are headed in business investment, again, this uncertainty has created, we have companies that have amassed huge amounts of cash that are sitting on the sidelines, not doing anything with that cash. And that's going to be critical for us going forward to that business investment, that construction, that commercial construction that we are not seeing, the industrial construction that we're not seeing. We have to be able to get past this and see businesses have more confidence in the economy and start to put forward some of those projects. On the energy side, we're seeing a transformation in energy unlike we've seen at any other time in history. The IEA is projecting that oil demand for light-duty vehicles will peak out in the mid-2020s, and most of that is due to acceleration of emission standards. And so the growth is expected to come from things like marine, aviation, freight, petrochemicals. All of those that demand growth is expected to slow. But again, that's risky, right? If you start to look at LNG versus oil with new emission standards that they're putting forward for marine freight, you can see that transformation could happen. You can see also in heavy-duty vehicles we could also see oil demand peak there. Petrochemicals, there's a huge push globally on single-use plastics. So again, these are all things we're expecting to count on for growth in oil demand going forward that are at risk. And so as we look to how that's happening, last year for electricity production, we saw 67% of capacity additions in 2017 were renewable, were solar and wind on a global basis. And so it is a very different environment going forward on the energy side of things too. And so as we look at how that industry is transforming, oil and gas is one of those that's going to have to transform. We've seen large companies around the world, the BPs of the world, the Shells, starting to get into the power generation business because they see the future of oil, especially, but also gas as being at risk. And so they're having to move into that power generation business. So as we look at the heavy equipment that's going to support that, we see more electrification. We see that becoming a piece of that, a larger piece of that business. Looking at things like construction products, electrification of those products, we can see that as our future as well. And so working in environments where we have bans on diesel vehicles in cities, especially in Europe that have announced many of these bans, it's not hard to see that move from light duty vehicles to heavy duty vehicles in those with those bans. And so electrification will continue to be a part of that. It's very specific to certain markets. We're not saying this is going to happen everywhere. We're saying that it's going to happen in these highly industrialized specific markets. If you look at Africa, that ban is probably not going to happen. You probably don't have the same constraints around equipment that in those regions that you do in more developed countries and in more industrialized cities. And so as we look forward, and look around our industries, there are challenges. We look at building construction, vertical construction as we move towards further urbanization. The footprints get smaller and smaller. And so we're going up instead of out in many cases. And all of these are contributing to different techniques and different machinery that's going to have to come into play going forward. As we look at resource industries, mining is a big part of our business, and you think of Caterpillar, you think of the roads, and you think of the big mining trucks, and so as goes China, so goes mining. If you look around the world, if you look at copper and you look at steel or iron ore, the economy in China really drives what's happening in those markets. And so as we're watching, you look at the current situation there with the economy weakening in China, it's a little bit counterintuitive that we actually see better activity on the construction side as a result of weakening activity, because you see the government coming in with infrastructure spend. And so that's one area that's a little unusual, but we do see the weakness in mineral prices and metal prices and things like that. And so that's impacting the resource industries. On the flip side, you also see coal production. As I mentioned, we've seen electricity production or electricity use for industrial customers declining in China. Therefore, the amount of coal that they're using to produce electricity is declining as well. And they're also closing their borders. So that impacts the regional economies, Indonesia, Australia, that are sending coal into China. And so we have two things happening in the Chinese economy, where you've got kind of this push and pull on the infrastructure side, as well as the mining side of the operations. Sorry, I'm off track on my notes a little bit, but so as we look and we look at how the biggest challenges we're seeing on a global basis, slowing growth and where this productivity is going to come from is really going to challenge the machinery industry. There's potential. As I said, we know of the infrastructure problems that we have here in the U.S. We know the need to build new roads, new bridges, replace all of those things. Getting past that hurdle and getting us to a bill that we can start to fund this is going to be critical in the machinery industry. Transforming our economy into a new energy environment. If if we look at the number of jobs that are created by renewable energy, it is substantial, and it has the potential to dwarf the existing resources that we use today in terms of the coal production that is declining here in the U.S. Excuse me. So as we look forward and we're trying to see where that innovation is going to come from, we see that productivity. We have to find a way to get the investment off the sidelines and to increase that productivity. That's going to drive that global growth. That's going to drive the heavy industry, the machinery business going forward. We need that activity and those resources to come forward in ways that we're not seeing today. And I think a lot of it revolves around this uncertainty that we're seeing. That's all I have prepared. I'm happy to answer questions, though, as we go forward.
We're going to take the questions at the end, Laura, so we're going to let Jim get up.
Thank you, Mike, and thank everybody. I want to talk about monetary policy, and I'm going to talk about monetary policy relative to the whole globe. And let me give you my conclusions up front. There's an old saying in the markets that the Fed decides when to raise rates and the markets decide when to cut rates. And that's exactly what's happening right now. That the beginning of the rate cut cycle is pretty much the typical what we've seen of all the rate cut cycles in the past. Why does the market think that we need to cut rates? Well, first of all, it's planet-wide. Everybody is now expecting eases all across the countries, major developed countries. I'll show a chart on that. I think it has a lot to do with inflation and the lack thereof, and probably the confusion about why we don't have any inflation as well too. And then there is some lingering doubt about uncertainty as relative to trade, but I'm going to downplay that a little bit. I don't think that's the major force behind a lot of this as well too. And there's a little bit of Einstein's definition of insanity, especially in Europe and Japan, doing the same thing over and over again and expecting a different result. So Mr. Draghi's already at minus 40 basis points and he's threatening to cut rates again, and I'm still waiting to figure out what minus 50 is going to do for us that minus 40 didn't do, and we'll see where we go from there. So let's start with the Fed. And here's the latest dot chart, and you can see that on the bottom of the chart there's a bunch of dots on the bottom that there was 8 members or that were looking for the Fed to cut rates 50 basis points in the next calendar year 2019. I believe one of those members is in this building right now as well too, and that they maintain that 50 basis points will continue through 2020 as well too. I strung together on this chart all of the long-term dot projections, and the red line on the chart is the median estimate. So if you look all the way over on the right at 250, we are, that's currently where we're at right now. So the Fed's long-term projection is, if nothing else, we're debating about when we're going to cut rates, that the rate hiking cycle's over, because we're now at the long-term projection for the first time since they started this exercise in 2012. The markets. Let's talk about where the markets are right now. This chart here shows the number of hikes priced in over the next year, and when it goes below zero, it's cuts. And right now, as of this morning, yes, Dave, I updated this morning, we have 3.78 cuts priced in. Round that to 4. We have 4 cuts priced in. 100 basis points is what the market is expecting, 1.25, if you want to put it in that regards. The market is a lot more aggressive than the economists are. I'll show you a chart on that in a second. As far as July goes, we have now hit 100% probability that the Fed will cut rates in July. That's the market pricing. There is no example example that I have seen when we've hit 100% and the Fed has not followed through. Now, we've hit 100% a lot. We had, I think, 5 of the 8 rate hikes had 100% at one point as well, too. That's not uncommon. But which would be a surprise is if there was no rate cut in July, once you got to 100%. As a matter of fact, all we seem to be arguing about right now is whether or not there'd be 25 or 50. Let's talk about the market's track record. So the Fed started in February of '94 with the statement. That's when they invented the Fed statement. That's when they solidified the idea that a move is defined as 25 basis points. And there's been 208 Fed meetings. So I looked at the market pricing of the 32, 35 days before the meeting. That's roughly 7 weeks. That's trading days, 7 weeks. That goes back to the previous meeting. We're in day 28. I'll show you that in the next slide in a second. And this is the probabilities that whatever's priced in on that day, the market's right. This goes all the way back to 94. You can see that in the 30s, it's 75%. It goes to the high 90s by the final 2 weeks before the meeting. Now, if I go to this chart, the top panel's the same here, but now I just start with the Bernanke Fed. So this is the last 108 meetings going back to January of '06, and you can see that it's in the low 80s, then it goes to the mid 90s by about a month before the meeting, and then 2 weeks before the meeting, it goes to 100%. Whatever's priced in 2 weeks before the meeting happens, with one exception. You'll see a 99% on one day before. That was the day after Lehman failed. So September 15th, 2008, Lehman files for bankruptcy. There happened to be a meeting on September 16th, pre-scheduled meeting. The market immediately after Lehman filed for bankruptcy priced in a cut for that meeting. The Fed did not cut that meeting. They cut intra-meeting a week later. So it was technically wrong, but the market had the right idea that this was a seminal event. It just took them a week to figure it out as well. Now, the middle panel shows you the probabilities of a cut at the July meeting. It's at 100%. And the bottom panel shows you the probabilities of a 50 basis point move. We're at 30 or 34%, depending on whether you use Bloomberg or the CME's methodology. They're slightly different, but they give essentially the same answer. So that's what I mean by that. We're really in the process right now of just debating 25 or 50. No move is off the table right now. It's just what is the size of the move. Now, I talked about the Economist. So the red line on this chart in the top panel is from is the Fed Fund futures market 1 year ahead. What's it pricing in as far as the rates go? The green bar line on the chart, I'll talk about the bars in a second, is a survey done by Bloomberg of about 70 economists. They do it on average about every 3 weeks. And they ask them, where do you think the funds rate's going to be in a year? And then the black line is the actual funds rate. And the bottom chart, I just converted it from yields to number of 25 basis point moves. And what you see at the right-hand side of the chart is the red line dove down first. That was the market pricing in cuts. As early as March, we were pricing in full cuts as early as March, but the economists did not go below zero until about 2 weeks ago. So they were still holding out that the idea that there'd be hikes or maybe no move until literally about the beginning of this month or so. So the market has definitely been leading them on the way down. Again, the market decides when to cut, the Fed decides when to ease, and then the other party gets dragged through it screaming and kicking. So that's essentially what we've got going on right now. I said that backwards. The market decides when to cut, and it drags the Fed along screaming and kicking, and the Fed decides when to hike, and it drags the market along screaming and kicking. So that's where we're at with it right now. Other measures that tell you that the Fed or the market is putting in a cut is the yield curve. So here's the 10-year, 3-month yield curve on the left, and the shaded areas are recessions, and there's a line on the chart, and that goes to the table on the right. And what the table shows you is whenever the yield curve has been inverted for 10 straight days. We did that June 4th. And right now we're at around, on the 20th when I last updated this, 16 days, so just add 3 days or so to that number as well too. And the market, on average, we have a recession about 311 days later. Now, a couple things about the yield curve. One, you need to use a yield curve with a policy rate, either the 3-month bill or the funds rate, and that is the market's opinion about policy. If you use the 2-year, 10-year curve, that's the market's opinion about the economy, is what that is, and it's not the same thing as policy. The market is saying that the Fed policy is too tight. Does it lead a recession? I've argued actually it causes a recession. And the way I've explained this is the policy's too tight today because the yield curve's inverted. It will be too tight tomorrow because most likely the yield curve will be inverted. That damages the economy. If you accumulate enough of these days in the 50, 75, 100-day range, then eventually to 300, you eventually have a recession. If you uninvert the curve after 20 or 30 days, you might actually avoid one. So we are in a period where the yield curve is telling us policy is too tight, it damages the economy, and that's why the market is demanding that the Fed drop short rates, steepen the curve, and at least take the pressure off is where we're going. Now, a lot of people will talk about that the reason is tariffs and uncertainty. So this nifty little chart comes from Vanderbilt University has a thing called the Television News Archive, and they've got the closed captioning of all television news. Every day they update it for the previous day. In the case of the network news, going back to the 1960s. So I took the cable news networks, including CNBC, Bloomberg, Fox Business, Fox, MSNBC, and CNN, and the metric that they use is the percentage of 15-second time slots that a word is in that metric. So I put in the word tariff, and I was looking at how much is cable news talking about tariffs as an indication of interest or on that. Now, what you'll see on this chart is it peaked in April and in July of 18 and was declining for about a year and was at about the lowest level of the Trump presidency in early May. And then on Cinco de Mayo, May 5th, Trump tweeted out that on Friday, we're going to put tariffs on China if we don't have a deal. And then the number turned around and it shot back up. So in my mind, tariffs began May 5th. There was nothing in the markets that was thinking that there was tariffs. In fact, if you go back to late April or early May, you actually had Mick Mulvaney and Steve Mnuchin saying 97% done, we're days away. There was none of this in the marketplace during that. And what's happened to markets since May 5th is that they've gone up and that they've rallied some more. And I don't think that this is really about uncertainty. I know that that's a buzzword we like to use. I think this is more about a lack of inflation. So let me run through some inflation numbers. Here's PCE, and this is, actually this is core PCE. The chart's mismarked. I forgot to change it. The Fed instituted its target in January of 2012, and it's only been above it 1 month, and that was July of 2004. July of 18 at 2.04. And the Fed knows this. They had a meeting 3 weeks ago in the room across the hall over here at the Fed Listens Conference. And part of the reason that they had that meeting was, why isn't inflation doing what we think it's supposed to be doing? And it's not just the Fed, it's everywhere else. In 2003, the ECB adopted their 2% inflation target rate, and the blue line is their core rate. They're going on 16 years now, and they've yet to hit their number. 1 month. It's not, and they're now well below 1% on their number. And you can see the headline number is in orange. And the Japanese have adopted their 2% target rate in 2013. And you can see that now in Japan, they do calculate taxes into their inflation rates. So when they raise their VAT or sales tax, national sales tax, you see the bump up in April of 14, and then March of 15, it bumped right back down. If you exclude out the taxes, they have not hit their target as well, too. So everybody's put on an inflation target, and no one's hit it, at least at this point. Now, part of the problem might be expectations. University of Michigan's Consumer Confidence Survey also asks a question about where do you think inflation is going to be over the next 5 to 10 years. Rich Clarida said that this number is at least as important to him as is all of the market measures, which I'll show on the next slides, all-time low. So here's the 30 years of inflation expectations by University of Michigan, and we're at an all-time low this month, well below where we were when we thought we were having a deflationary bust in 2008. So not only don't we have any inflation and we can't hit the target, but this metric of inflation expectations is at an all-time low. TIPS break-evens, the real rate market, if you take nominal yields to 10-year minus the 10-year real yield, you can get the market's expectations of inflation. That was recently, as in a couple of days ago, at a 2.5-year low in the United States. And if I go to Europe, Mario Draghi's favorite metric for inflation, I know that because he said this repeatedly, is the five-year forward inflation rate. That is, you take the 10-year inflation break-even rate and the 5-year inflation break-even rate, and you calculate what will be the 5-year average in 5 years, because that's supposed to remove all the short-term noise of oil and everything else, all-time low. And as a matter of fact, when Mario Draghi spoke last week, and he talked about opening the possibility of rate cuts, he mentioned this number 3 times, that this is actually monetary policy in Europe, this metric right here, and that it is at an all-time low as well, too. So not only can't you hit your inflation targets, but all the forward measures, and here's the one for Japan, their 10-year inflation break-even rate is down, and it's almost back to zero again right now. It's under 20 basis points. So not only don't you have inflation, you have expectations that there actually is no inflation. Before I get to the next chart, I would actually argue in Fed speak or in central bank speak, they like to talk about whether or not inflation is well anchored. And I think that the proper way to put this is, it's never been anchored in Japan. It became unanchored in Europe recently, and we're on the fence of becoming unanchored in the United States. That inflation is slow and there's no expectation that it's coming back, and I think this is the primary driver for the next chart. So here's probability of policy rate cuts for the United States, the Eurozone, and Japan. This is the same chart I showed you before. So the orange line is just turned upside down. That's the US at 100% that we're going to cut rates. The red line is the Eurozone. They're at 78%. That date there is the last meeting of the year. So by December 11th, we have a 100% chance we're going to cut rates. We've got a 78% chance Europe's going to cut rates by the end of the year, and we're in the high 50s right now for Japan. It's the first time just in the last couple of weeks that we've actually had the 3 major central banks all align that they will cut rates before the end of the year. And I think the driver of this is no inflation. Now, what's interesting about this is here's the policy rates. So the red line is the US at 2 3/8. The blue line is Japan at minus 10 basis points, and Europe is at minus 40. And this is where Einstein's theory of insanity comes in. Minus 40 is not low enough, we need to lower it. Minus 10 is not low enough, we need to lower it. I can understand why 2 3/8 might be too high, and we could lower that, but we want to go deeply or more negative, and that seems to be what we're pushing here on this. As far as the balance sheets go, they've talked about the possibility of them expanding their balance sheets. So here's the central bank balance sheets to GDP ratios. In red is the US at the bottom at 18% of GDP. Europe's at 39%, and they're promising us that they're going to go higher, because at 39 or 40%, that's not stimulative enough. But if they go to 50 or 60, that's going to fix their problem. Japan's balance sheet right now has exceeded the size of their economy, and they've promised us that they will continue to expand their balance sheet if necessary, because 102% is not enough. But if we got to 120, I think we would fix that problem, or that's what they think that they're going to do. They've got nothing else to do except to just keep doing the same things over and over. And that gets me to negative yielding bonds. So top panel here shows this is sovereign debt markets, the market cap of sovereign debt markets. There's $54 trillion of sovereign debt in the world, 20-ish or so is in the US. The other 34 is everywhere else. Developed markets, so this doesn't include any of the EMs. Right now, we just set a new record. We're at 12.75% of that is in the is negative, excuse me. And that's around 23% of the sovereign debt market is actually negative right now. So almost a quarter of it, and that's pretty much where we were back in 2016. Now, there's an interesting argument to be made. Oh, before I do that, let me just mention, where is the negative yielding debt? So about 2/3 of it is in Japan. The rest of it is largely in Europe, under the Eurozone, and then the gray is other, and that's largely Switzerland right there. So that's where it is. And then you can see on the chart on the right, the pie chart on the right, I'll just point out that the red slice in the pie chart on the right shows you there's $8.5 trillion worth of debt that is yielding more than 2%. 90% of that's in the United States right now. And then when you get to below 1% and negative, none of that's in the United States right now. And then the other fun stat I will give you, of that $54 trillion of sovereign debt in the world, 94% of it is now yielding less than the funds rate. In fact, there's a possibility if we continue this rally in the bond market that we could actually wind up having the highest sovereign yield in the world wind up being the United States federal funds rate before we get to July 31st. That the Fed will then be sitting with their policy rate being the single highest rate anywhere on the developed world planet. But I think that, before I go there, I think the issue now becomes, what does this mean that we have negative yielding debt? And why do we keep pushing it? There was a belief, and I was in this camp for many years after the financial crisis, that this represented a manipulation by central banks, that they cut their rates to zero and they went to zero. But there's something more going on there. When you've got Europe, when you've got Germany's 10-year yield now minus 32 basis points, even lower now, or more negative, I guess is the proper way to say it, than Japan, which is begged the joke now that people are in the rest of Europe are going, oh my God, look at Germany, they're worse than Japan right now as far as negative yielding debt. And this has been going on for so long that we've now started to ask the question as to why are we persistently negative? It's just not that we've set policy rates there. And we're coming around to a possibility of the answer is that in the post-crisis era, with the abundance of capital that we have worldwide, that is now the new normal, is that it's negative. This is not an argument that this time is different. It's already been different for 10 years that we're in a negative interest rate environment. And the problem with the negative interest rate environment gets to the next two charts. So here's the Euro stock index, bank stocks in blue. And this is the German 2-year yield, because that's as farthest I could find back. If you bought European bank stocks on the day of the stock market crash in 1987, almost 32 years ago, congratulations, you just made money on that trade just in the last week, is basically what's happened. You've made no money on it in the last 2 years, and you can see the relationship with yields as well too. And if you bought stocks on the day of the stock market crash at 87, Japanese bank stocks, well, I'm sorry to tell you, you're still at a loss after 32 years. And you can see the relationship with the Japanese 2-year. If we are in an era of negative rates is the new normal because of an abundance of capital, and it's simply a case of, look, here's some money, you don't have anything to do with it, you could put it in your mattress, and you could then, calculate the possibility that it gets destroyed or it gets becomes obsolete or something, and then, or you could put it in the bank, and that's what a negative interest rate is essentially winding up being, that we have this abundance of capital. What I'm showing here with these charts is the fractional banking system is not set up for a negative yield. That if we are in a new era of negative yields, and we are going to stay in a new era of negative yields, we're going to have to rethink the fractional banking system, because it doesn't work in a negative yielding environment right now. And if you look at Europe and if you look at Japan, they're fully set to go further negative right now, and they're going to stress their banking systems a little bit more. June 5th, across the hall here at the Fed Speaks conference, Jay Powell opened up the conference and he introduced a new term. Now, one of my pet peeves about the Fed is that every 6 months they have to change all the terms on everything, right? We used to call it money printing, then it was QE, then it was large scale asset purchases, and now it's called level policy. If you haven't heard this one, then 3 weeks ago we've changed it to level policy. We used to call it unconventional policy, forward guidance, and now it's called slope policy. So slope of the level as well. And then zero lower bound, or ZLB, all of a sudden became ELB, or effective lower bound, which is got me and a lot of other people thinking, did he just open the door for negative rates in the United States by going from 0 to effective, because effective now can be anything we want it to be as well too. You know, what I wanted to show with these charts is it's devastating, negative rates for your financial system, unless you get a new financial system. And maybe cryptocurrencies and Libra from Facebook and all that might be our new financial system, but that's still ways off. That's just more of a concept than anything else. But what we do know is negative interest rates do devastate your financial system, and that's the risk that you take when you go there, because a fractional banking system in a negative rate world, the two are really not that compatible with each other. So let me sum it up again. Everybody's looking to cut rates. I think that the biggest question that we have is there is no inflation. There is no expectations of inflation. I think it's unanchored in Japan. I think it's always been unanchored in Japan. I think that inflation expectations became unanchored in Europe, and we're at a threat of it happening here in the United States right now, and that's why there's this zeal to pull rates down. Not in the case of the Fed, but definitely in the case of the ECB, definitely in the case of Japan, we don't know what to do, so we're just going to do more of the same. We'll just keep going further negative. We'll just keep expanding the balance sheet more, because that's all we really know what to do. There is some uncertainty out there in the markets, but that's being tempered by new all-time highs in the stock market. Confidence is staying up because of the all-time highs in the stock market. As I pointed out, I think that the trade talks are just 6 or 7 weeks old in the United States. We had largely dismissed them till early May. And so I do think that as we move forward, it's really going to be more about why don't we have any inflation? And that was one of the primary subjects of the Fed Listens tour. And until we get that, we're going to have to look to be cutting rates. So thank you. I guess we're now into Q&A.
Q&A.
Okay.
So I'm going to pass up the moderator's advantage in asking the first question, because I'm confused. So I'm going to throw it open to the audience. Questions from the audience? Or stunned silence, which is often the result of. Mr. Cleese.
For David. So we know that the labor costs rise, continue to rise. Firms try to substitute labor,
Capital labor, yeah.
So are we seeing that in the housing industry at all? Increases in prefab homes and any of that stuff?
There is some of that. Again, talking with the builders, it's still very small, and it's not manufactured housing in the historical sense. These are homes that are factory built. The components are factory built, and then they're assembled on site. It's still a very small share of the market. We're seeing more of that now. And I think if the labor situation remains extremely tight, we'll see more of that. We're starting to hear some of the big national builders talking about that as well.
I got a question for you, Dave. In cutting rates, there's an argument that the Fed's pushing on a string. What's it going to accomplish? In cutting rates and lowering mortgage rates, is that going to matter for the housing market? Is that going to, or will it not matter, as a lot of people are arguing?
Well, it does matter. We've seen mortgage applications up significantly. Volatile series, smooth it, it's up significantly. People don't apply for loans unless they expect to buy a house. Now, they might end up not buying it. But there's an increased desire to buy homes. Is it huge? No. Are mortgage applications where they were in 2005? No, and nor do we want them to be. But there is directionally the response we want. It's just not big.
I want to ask Laura the same question. If we cut rates and interest rates fall, will you see it in heavy manufacturing and will you see it in your industry, or are they pushing on a string there?
I think they are. I mean, as we look, we're not seeing, we're still so stuck on this infrastructure, the need for infrastructure and the inability for them to agree on an infrastructure bill, that I don't think rates are really the core issue. And so until we can get past that, we just won't see the heavy machinery business really start to take off unless we can solve that issue. And I don't think it's a rate issue at all.
Kathleen?
Does this work? No? Okay. I have actually a question for each one, and I allow you. Okay. So, David, can you talk a little bit about the regional developments? And then for Laura, the uncertainty that we're seeing might be translated in numbers such as the very big numbers in global trade. Mm-hmm. And to what extent does a company like Capital react to that? How nimble can it be if you think that this is a structural development in the global, or if it is only a reaction to trade uncertainty? And Jim, what you're describing seems to indicate that we must rethink the monetary policy framework. And the question that I have, do you espouse the view of higher fiscal spending, assuming that the transmission mechanisms are well in place?
And let me take the prerogative of also appending onto Kathleen's question to David, because that was my question, which is on the regional, but I was just going to add on to that implications now that we are a year and a half into the SALT provisions with regard to
I was going to bring that in. Exactly. So we're not seeing huge regional differences in demand. What we are seeing are regional differences in supply. Yeah, there are differences in demand. People move to San Jose, they don't move to Bismarck. On the other hand, if you look at prices in Bismarck relative to where growth rates and prices there relative to where they usually are, it's not unusually low or high. It's probably about right. We're seeing unusually rapid price gains in parts of the country where there's a greater lack of supply response. I've lived in California twice, and lots of people want to live in California, particularly Northern California, and beautiful views, and you look at the hills and you realize, oh, they don't build houses up there, and there's an ocean over here, so you have greatly reduced the amount of land that you're allowing to be built for housing, so you have artificially suppressed the supply response in those areas. So you end up with very inelastic supply curves in places like coastal California. What we are seeing, and I'll bring Bill's question, rather than areas of regional weakness, we're not seeing regional weakness. We're seeing strength or even greater strength regionally. We are seeing differences in what's happening by price tier. And this is true almost without regard to where you are regionally. Where over the last year, the slowest price gains, again, across virtually all markets, are the upper tier homes, the upper 10 to 15% of homes. And once you get to a level of home where it is less likely that these SALT deductions would be used, but they're used at all levels, but less likely, then we're seeing price gains that are at or above the national average. But we're seeing it decidedly below where you've seen the impact of the limitation on deductions and the limitation on the home mortgage interest deduction as well.
So with respect to trade, as we look at our global footprint, we have manufacturing around the world. And that helps us to offset some of those issues. But when you start looking at supply chain and you start thinking about how to, if you look at the automotive industry, for example, the threat of the tariffs on Mexico were substantial. It was substantial for us as well because we have facilities in Mexico that supply to our U.S. production facilities. And so you think about the number of times parts go back and forth across the border, that was a substantial hit if that were to go into effect. And so I think the biggest thing that's going to happen if this current environment of me first, whatever your country is, right? Make America great. Everybody's got their own version of this, right? And it seems to be coming to the forefront around the world. And so with that, I think the supply chains are going to have to be rethought in how we move equipment across and parts across for manufacturing purposes. We look at the potential for European auto tariffs and that threat that still remains out there. But you think BMW makes their cars here in the U.S. Most of the manufacturers make their cars here in the U.S. But the engines are still coming from Germany. And you're still going to see the tariffs as a result of that, impact that piece of it. And so it doesn't really matter because we've created this global supply chain for parts that even where the final goods are manufactured doesn't matter so much because you've got all of this happening across. And so I think the supply chain issue is a big one. And if we think that this is going to persist, it's going to make all of us rethink how we ship parts across and how we manufacture our products.
The question was to rethink the framework of monetary policy and will it lead to higher fiscal spending. Let me interpret that question as, are we going to get MMT? And if that's coming down the pike. And the way that I've argued with MMT is it doesn't matter what you think of its virtues, and the answer is we are going to get it. And we're going to get it one way or another. Jeremy Corbyn in the UK has already got a QE for the People program already on the books right now he's proposing QE for the people. If you go to these investment conferences, most of the time what you'll hear, and you even heard it at the Fed conference too, the next downturn, they're coming after all the wealthy with pitchforks. So we have to do what we can to stop it, and that's why Ray Dalio writes his 2-volume piece, and he says we've got a big problem with inequality, and the answer is I will pay protection money by you tax me to death, so it's protection money, so you don't come after me in the next downturn. Just leave me in my submarine in the Caribbean, if you saw him on 60 Minutes in March as well too. I think it is coming, and I do think that there is a way that we can head it off as far as looking at the framework. Fractional banking doesn't work in a negative rate environment. Last week's announcement by Facebook, I mentioned it briefly, about that they're going to create a payment system under the name of Libra, I think is, now again, there's some technical hurdles they got to come up with and stuff, but keep in mind the power that Facebook has. There are 2.3 billion Christians in the world today. There are 2.8 billion people with a Facebook account. Facebook is more popular than Christianity. So it is a big deal. If they could come up with a payment system that works, it will go from an idea to the reserve currency almost overnight. It has that potential to do it. The way to head that off is what has been in the vernacular known as FedCoin, that the Fed needs to create its own cryptocurrency. And if they did that and created a cryptocurrency where you'd have a bank account at the Fed, instead of paying interest on excess reserves to the banks, which I still would argue Liz Warren is going to shut down one of these days when she realizes that Jamie Dimon's being handed $7 billion a year from the Federal Reserve, even though he's a profitable bank, because of their 25% of all of the excess reserves, and 1.4 trillion of excess reserves, 25% of it is at JP Morgan. 75% of it is at Morgan, Wells, Citi, and B of A. If you created a Fed coin and you created this idea, they could pay interest on excess reserves to everybody. They could just put it in your account. That if you put your money with the Fed, now you would disintermediate the financial system, but it's probably going to be done by Facebook or Google or whoever comes up with this anyway. So you can either control it or you can let it control you. So I do think that there is a framework coming as far as a new monetary system if we are indeed in a negative rate world, and that this isn't just something temporary, but it is a new reality post-crisis. And if that is, it will revolve around a complete restructuring of the system as well too. And will it lead to higher fiscal spending? Probably at some point, but more likely it will lead to to use Corbyn's phrase, QE for the people, that we will find a way that we will give you the QE money as opposed to everybody else. Because, I mean, I read it today that somebody, to put it in, bluntly, the next downturn, we're going to do QE. And if the propeller heads at the Fed think, well, they're going to sit around and go, what QSIPs are we going to buy in the next downturn? No, everybody's going to get their college tuition paid off. And then we're going to talk about printing money and paying for Medicare for all. That's what we're going to wind up facing. So if we don't get about changing the framework to at least make it look a little bit more fair, that could be forced down on us in the next downturn. Like I said, there is something different about a negative rate environment, and it doesn't gel with a fractional banking system. And either we have to come to the conclusion that this is actually temporary, we're going back to positive, we're 10 years past the crisis now, and we're getting more negative by the day here, or we have to realize this is the new reality and start thinking about a new system altogether.
So a follow-up on that for both Jim and Laura. The street says that we're going to ease 4 times. There are negative interest rates in most of the rest of the world. You ease 4 times in the United States, and you don't ease 4 times in the rest of the world because you can't. Currencies are going to move. The yuan would probably appreciate in that environment because it still has positive rates, and the currencies in Europe would probably appreciate in that environment. They would be importing deflation that they already don't want, and China would be importing a stronger currency, which helps them in their commodities demand. How does that play out? That's what I thought. I'm not sure you can get there from here, but that's my question.
I'm not sure you can either.
Let me take it while you think about it for a minute. I think you're right that is the standard textbook argument for what would happen if, and you're basically talking about the relative changes of exchange rates. The only caveat I would give you is, I know we have 5,000 years of history of what happens when we have positive rates and you lower them when you raise them. If you lower them, it's stimulative, and if you raise them, it's restrictive. And I know that the Larry Summers and Brad DeLongs of the world used to say, what's the next number after 1? It's 0. What's the next number after 0? It's -1. That the same relationship just keeps holding as you keep going negative. And I think what we've learned is that's not the case. That when you get to 0 and then go negative, that 5,000 years of history of how stimulative interest rates are, we don't know what it is when you're in a negative rate environment, but we just know that it isn't the same as cutting from 2 to 1. And so we'll cut from 2 to 1, we get what that means. But what does it mean if they cut from -40 to something more, -10 to something more? No idea what that means as well too. So we have to kind of figure this whole one out. I don't know if we do. I don't know what it is. So what I'm saying is your answer was right.
I agree. I mean, I think the relationships, we don't have enough experience with those relationships to know how they're going to go forward and how countries are going to react to them. And I think that's probably the biggest thing that we're seeing. Again, I think it's probably a lot of the reason why we continue to see people sit on the sidelines and wait, because they're still trying to figure all of this out. That we're just not, there's so much uncertainty around how all these relationships work together and integrate that nobody is doing much of anything.
One fun anecdote for you is in 2016, adjustable rate mortgages first went negative in Europe, especially in the Scandinavian countries. And there was a great Wall Street Journal story in 2016 about arm terms got readjusted to negative, so the bank had to write you a check. And the bank had no computer system set up for the idea that they'd have a negative rate, so they actually wrote the checks out by hand and they sent them out. And then the story went on to say that 90% of these were small numbers now, right? 30 euro, 40 euro, 10 euro. These were not big numbers, but you got a mortgage check from the bank. 90% of the checks were not cashed. And when they went to find out what happened with them, most people framed them and put it on the wall. They couldn't believe what was happening, and it had more value as a collector's item for them than the actual monetary value of the check as well, too. So we don't know what happens in negative rates. Nobody knows what they're supposed to do. We put the check on the wall because we can't believe it, as opposed to saying this is money. And that's really kind of what happens from there.
Let me just follow. Interestingly, in the U.S., the notes are written so the rates can't go negative, unlike in some European countries.
So this is a hypothetical that I hope does not come to pass, but how would war of some substance, let's just say the Middle East, for example, affect your assumptions on inflation, materials production, and so on? Laura, I did notice, I don't know which chart it was exactly, but Saudi Arabia was the only country that had moved into the green. So it's hypothetical, I hope.
I agree. I hope so too. I think anything that creates, if we were to have war, that's going to, obviously, we're going to see increases in oil prices. Especially a war in the Middle East, we will see those increases in oil prices. That will stimulate production here in the U.S. As far as some of the other mining commodities, I don't think we'll see as significant of an impact. A lot of it would depend on duration, as to whether we see the steel prices increase and things like that, where we would need to build out the war defense spending. So I think that it's primarily going to have a short-term impact on oil, and we would see the stimulation in the U.S. piece of that. Obviously, on the heavy machinery side of things, whenever things are destroyed, they have to be rebuilt. So that would lead to an increased demand.
I have a comment and a question. I always think when I come to these kind of conferences, what will I remember in 5 years and what will we have missed, too? I think Jim's comment on cryptocurrencies is one of the things that you'll remember, because look at 2019. Decentralized cryptocurrencies are the best performing asset of 2019 so far. So it's in progress, but we minimize it, and it's going to become more important. I agree. But the other thing I think we might think of is, how did we miss potential inflation shocks? When everybody says it's dead and it's not going to happen, I can't help but thinking, yes, it could, and war is one possibility. But increase in labor costs, what are other places where we might find an inflation shock that we're not seeing right now?
Let me take a quick comment on the first part of it. It's funny you mentioned that about what you're going to remember in 5 years, because last night at dinner I said, if you saw the transcript of what Jay Powell said at his presser on Wednesday, I said, I think that the most important thing that will be remembered in 5 years is when he said cryptocurrencies are in their infancy and they don't pose any kind of problem whatsoever. And I said, be careful on that. And also keep in mind that there are now 4 billion smartphones, billion with a B smartphones in the world. And the US ranks like number 40 in terms of broadband speeds. There's a lot of third world countries where they have smartphones. The adoption rate of smartphones in the poorest countries of the world is 70%. In the developed countries, it's 120, meaning that you have 1.2 phones per person. And so if you put together and if you think about the adoption rate of the internet and even mobile phones itself, if you put together a currency that can work under a Facebook or a Google or something like that, the adoption rates can go completely vertical and so fast. You can go from it not existing to being the dominant thing in a very short period of time. And that's what they have to start thinking about in terms of it. Did you guys have anything about the inflation part? Where's the inflation? When are we going to get it? Do we have in the labor market, just to get it lower still, we have wages are going up, productivity is going up. That's actually the best of all worlds.
Don't step onto the next panel, Dave.
Hey, it's the best of all worlds.
We're going to take one last question from Pat Allwell, but before we do that, I'd just like to point out that your cryptocurrency world where these things rule the world, I just got back from Western China, where you cannot pay for things in cash or with credit cards. You must have WeChat money on your phone or you can't pay. And as for putting money in the bank, you don't put money in the bank, you put money in your Alipay Taibo account. That industry went from $0 to $120 billion in 6 months. These things are happening. They're just not happening in the United States because there's institutional structure here to stop them. There's no institutional structure in most of Asia, most of Africa, large parts of Latin America. So it's going to happen. It's just not going to happen here.
Credit cards are non-existent.
Yeah, in Kenya, and just real quick, in Kenya, M-Pesa's got a higher penetration rate than the United States. It's not, literally, there's people that still live in huts, and in the middle of town is a Honda generator, and they charge their 50 phones overnight, and they all text money back and forth to each other in Kenya. And here in the United States, we're not even at that point yet. So they're moving way ahead of us as far as this adoption rate goes.
Okay, so Pat Allwell stands between us and lunch.
I'll make it quick then. So it seems to me cryptocurrencies are about distrust, right? You don't trust the system. You have $13.5 trillion in negative interest rates. So gold recently, the old money, has been going up. And as you pointed out, Bitcoin has been going up. Why in the world would anybody who distrusts governments or institutions buy a Federal Reserve coin when Ken Rogoff a couple of years ago was talking about banning the $100 bill, and Ketch Lakota in Minneapolis was writing, "Don't fear negative interest rates. It would give the Fed the ability, if people had their money in a bank deposit controlled by the Fed, we'd make it, well, tomorrow, Cadmus, you're going to have 99 cents. And if you don't spend it tomorrow, you're going to have 98 cents. And if you don't do that, we're going to make it 97 cents. The Fed would have more control rather than less. Why would anyone buy a Federal Reserve cryptocurrency?
That's a good question. I mean that is a problem that the established central banks will have to face. I mean, you're exactly right. Why do we have cryptos in the first place? It is a backlash to the financial crisis that we don't trust the financial system. That's why it exists to begin with. And you're right, 12 trillion in negative interest rates. By the way, there's only 8 trillion of gold outstanding right now, so we have more negative interest rates than we have gold. And so it is going to be a real issue for them. But I mean, the other option they have. So what are the options that, like, the Fed has? So we're just going to sit around and we're going to watch, forget Jay Powell being demoted. The next Fed chairman will be Mark Zuckerberg when Libra takes off. I mean, or are we going to try and do something in the process of trying to be part of that process as well, too? And that's where a Fed coin could come in. Now, you're right. They're going to have real problems with it in terms of that they could change the rules. There's also going to be government disclosure with it. Does the Fed then just go and look at what I've spent my money on and make judgments about me, or pass that along to the government that can make judgments about me? So there are issues. It's not just as simple as, hey, do this and it goes away. And you brought up some really good points.
But like, I was just trying to throw a comment, then maybe we can close and go to lunch after that, which is that keep in mind, these cryptocurrencies are fiat currencies. There's nothing giving any backing to it outside of people's beliefs, same as every other currency in the world.
All right, we're going to have a spirited discussion at lunch.
Who remembers Mount Gox?
Thank you. Thank you.
That was not exchange. You don't need an exchange. There would be something like that. You don't need that.
But I would say the other thing about
the reason why cryptocurrencies are so attractive is because they're anonymous.
Right.
And regulations were put in into place.
And when they were originally being sold.
Now Catherine Mann is cutting into Catherine Mann's time.
And when they were originally being sold, they were supposed to be a replacement for the concern about hyperinflation from the central banks printing too much money, and these would be a stable way of holding on to your assets. It's anything but stable.
Those of you who are excited about cyber currencies, cryptocurrencies, GIC is holding a conference in San Diego on
February 3rd, imagine that.
San Diego on February 3rd.
Commercial, we'll have people in the Fed, from the suppliers, third time we'll be doing it, and you can go through every detail of the currency. And